In this video, I would like to show you a new position that I have just opened on my live trader account. The idea is the following. We are looking at the SPX daily chart right now, and you can see this downtrend line, and the market hit the downtrend line today. We are just like 30 minutes after the open, and I think that the market might be able to make a new all-time high, but not very violently, because I think this run-up is pretty powerful, and I don't think that the market will run as fast as before. So I was looking for a call diagonal in SPX, where the upper strike of the diagonal, which is the short strike, is around 6925, and the long strike is 6930. And this is the GEX profile, as you can tell, and I was aiming for the 12th of December, which is this expiration line, as you can tell, this vertical line. And this rectangle shows you the break-even zone or the range where the position might be profitable around expiration, before expiration. And to show you how it looks like, I am going to show the risk analysis curve on Thinkorswim platform. This is what I mainly use for risk analysis. And here you can see the exact setup is the 12th of December and the 15th of December. And these are the strikes, and this was the premium. So as you can tell, this has a pretty wide break-even range on the upside, but you have to know about time spreads that this expiration line is not set in stone. So it changes during the lifetime of the trade, and it really depends on how implied volatility skew moves during the lifetime of the trade. Right now I was filled at 1.6, and here is the screenshot of the trade from Trader. Here you can see the sell to open was the short leg, and the buy to open was the long leg, and this is the 12th of December, this is the 15th of December. And the debit was $1.6. So this is how the position was opened on Trader, and we still have like 11 days until expiration. And the important thing about diagonals is that with time, it will make money if the market shoots a little up or moves sideways around this area. So it can make money either at sideways movement or a little up. If the market shoots above the short strike, that's problematic, and I need to adjust the position. But this is not what I'm expecting, because as you can tell, this 6900 level is a pretty high GEX level for this expiration. That's why I'm targeting above that line, because this line can hold the market a little bit back. So that's why I'm not aiming for a much higher price like this or this. So this is the main idea behind the trade, and from now on I will continue to track this position as the market unfolds, and then time passes away, and then we will see how the position will change after all. So I will continue from here. I'm back again. It's the 10th of December. We are on a Wednesday, and as it was expected, the Fed cut interest rate by 25 basis points today, and the market liked it. And after the press conference and Powell words, the market even liked it better, because this is a very nice green candle shooting up. And we have to note very many differences from the last recording. I opened up the position here. It was the 1st of December in this candle, and the market has been steadily grinding higher since then, and there are also notable things to discuss. Both the IVR and IVX has been falling since the last recording, and also the put pricing skew. The other thing is that in the last recording you see that the main put support was 6,600, right now is 6,800, and also HVL line moved above. It was lower in the previous recording, and last time we had the major core resistance around 6,900, and right now it became 6,950. So the whole thing became even more bullish. And the other thing someone might notice, that these expiry vertical skews also turned bullish. These numbers were red in the last recording, so this also assumes that the market turned bullish. very bullish after this FOMC statement. We will know how far it will last, but probably the market is pricing a new all-time high. That's why what I did to this position is that, remember, on the 1st of December, I opened it for 160. And right now, after the FOMC statement was out and the press conference is done, I could close half of the position for 3.2, which means that the lower debit that I paid for the whole thing is gone, because I paid 3.2 and now I could get back another $3.2. That's why there is no downside risk. Here is the fill from the MyTrader live account. So as you can see, the credit was filled for 3.2. And this means that I can still hold on to this position, because if the market turns around tomorrow and goes south, I will have nothing to lose. There is still upside risk, a little upside risk, because of the diagonal part of the position. If the market shoots up another 200 points tomorrow, that's a problem, but this is still have positive delta, and I will keep continue monitoring it, because I would like to make a little more money than that. Maybe this happens, maybe not, I'm not sure, but the market is probably heading to the previous high, which was around this area, and that is why I always build my call diagonals around previous levels. That's why this call diagonal has 6925 as the short strike, and that is why I am leaving here at least for another day, and let's see tomorrow on Thursday how it will look like. I don't like to hold this position until Friday. Usually I close them down around Wednesday or Thursday latest. So right now what I could do is just close the whole thing down for a 100% profit, but I still want to keep it for tomorrow, because if this grinding higher continues, then I could, for example, sell it for 4.5, around that number, maybe. We will see. We will see. If the market decides to gap down, that's another story. Then I will lose what was already in the position as a profit. But there is nothing to lose on the downside. There is still a potential to lose on the upside if there is a huge upside move overnight, maybe, but that's not very realistic after this green candle. So let's see what the market will do tomorrow, and then I will continue from here. I'm back again. It's the 11th of December. We are on a Thursday, and yesterday was the FOMC, and this was a really nice green candle as a daily candle. And as you can see from today's candle, it was pretty hectic, because the market went down to the previous low, then rallied back up, and now it's around here. And what we can notice from yesterday's GEX profile is that this was, the put support was around 6,800, exactly 6,800, this number, and not 6,850, so it moved up a little bit. And the other thing is that the put skew has increased tremendously since yesterday, and also if you look at the vertical skews for different expirations, they are much more in red than yesterday. Yesterday the three next expirations had like a little call skew in it. Right now these are all red, so the market turned, the sentiment turned a little bit more bearish. And if we look into the 15-minute candles just to see how the market is doing, you should check the settings in here and set it to 0DT if you want to see the 0DT moves. What we can see from here, that the 6,850 did not hold the market, went back to the next put support, the 68.35, which was coincidentally these technical levels. So this was a pretty strong technical level from the previous days, and this is where the market bounced back from. And right now on the intraday chart, what we can see is that we are below HVL, so this is a negative GEX territory, which means the negative GEX profile always means that the moves can be accelerating. So there are up and down moves very fast. And here is the HVL line, and for today 6,900 is the call resistance on the upside. After looking at this profile and how the market is shifting very quickly because we are in negative GEX territory, I decided to close the other half of the position. If you look at my call diagonal, The price of the diagonal when we went down here was around $2. Right now what I could close it for is 3.25, and here you can see my screenshot from my live trader account. 3.25 credit what I got for closing the position. And as you can see, if I click in here, the cumulative profit of the whole position became $325, and the initial risk was 320. So it's a little bit above 100%, which is very nice for a core diagonal in 2 weeks or less than 2 weeks. I just wanted to show you another adjustment possibility that someone can do if you have a diagonal like this and still want to stay in the position but don't want to risk the downside, or at least harvest some of the money you have on the table. You can short a vertical spread, which means that you are rolling the 69.30 to 69.35, and that's why you get $1.10 as a credit. And if you do that, you will move up the lower leg of the risk curve, and you will create more risk on the upside, because this has higher risk, because the previous or the original 5 difference in the spread became 10 difference because you widened the whole thing by $5. So this is another adjustment someone can do if someone does not want to close down the position but stay in it and keeping the positive data if the market sentiment of the trader is positive data. So what we can see from the intraday chart is that there was a quick rally back up to almost a gap fill, but the market was not able to close the gap and go to the HVL line, and the 8 Merrimack was a little resistance for this move. So this is how the position ended, with a $325 profit. If you have any questions, just let me know. Thank you for your attention. Take care. Bye.
Thanks for watching. If you haven't yet, please subscribe and check out our other videos. You can always find us at the links in the description. Trade safe out there.